North American markets are at record highs. Central banks are embarking on a new rate cutting cycle. Ooh, don't get those messed up. But as we head into the months that are generally weak for the markets, can this run continue? Joining us now is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, great to have you back on the program.
Greg, it's great to be here.
Our mission always when we have you on the show is to make sense of the world. So let's start with these equity markets hitting new highs. This traditionally isn't supposed to be a kind month for equities. What's going on?
Yeah, okay, well, it's, right out of the gate, what kind of my goal here today is often I think that we live in a world that might be a post-fact society. So I think maybe why don't we, middle of a market that clearly has a little bit of froth right now, maybe we'll do a little myth busting right out of the gate and start kind of framing it that way. So I actually brought a chart along that looks at volatility. Now I think that one way up there is about rate cuts, and let me come back to that one. Let's go to volatility. It's perfect. So, I think we typically enter the fall and think, oh no, we're going to have a big correction or worry about that and higher volatility. So what we're looking on the screen here is we went back about 30 years and looked at market corrections over that period of time. And so since 2000, and said, okay, as we move into October and November, what has really happened? Now, why we're worried about fall market corrections? Because we've had some big ones, right? We've had 2007 and 8. What was that? Of course, we had October '87. But if you look at that 30-year cycle, actually what you see is that kind of plus or minus in between September and October, which are usually the big ones, on average, since that 20-year period, you're on average up or down 1.5% between those couple months. The green is what you're seeing is the VIX, which is volatility. And so I think that the myth busting is a little bit is, yes, we've had on the outliers, so if the world was a bell curve, you have on the outside, we have had extreme market downsides in the fall, but on average, most of the time, it's actually been pretty good. And if you go all the way back to 2020, in 1929, so throw in the big, huge correction there, on average, your up or down cycle, again, is somewhere between up or down 1.5% between those two. So yes, we get more volatility, but the green line and seeing the volatility up, I think, is what happens is that, markets become much more quiet in the summer. The liquidity drives up a little bit in there. People's activity drives up a little bit. And this is a bit of a nudge. It's a bit of a push to kind of wake you up again, start you up again, to look and go, wait a minute here. Let's get back in focus a bit. And I think that's, if anything, that's what that little bump you see in the VIX is. But on average, let's be careful about making any big assumptions.
Generalizations. The markets, we know, are forward-looking instruments. We have weakening job markets on both sides of the border. We have concerns about our economy, what could happen with the U.S. economy. Right. What's the market telling us about recession fears?
Yeah, well, I guess maybe the perfect place to start there is, as you said on the way in, we had an interest rate cut from the Bank of Canada, and then, of course, we had the big one, the interest rate cut coming from the Fed. And so 25 basis points. So again, I'm going to use this as a little bit of a myth-busting tour, if you will. And so, I brought this chart along just again to help frame this a little bit. We're going to see in the next couple days from investment firms all over the place showing that, okay, we're at the beginning of an interest rate cycle, and what does this mean? What I'm showing here is that we're not at the beginning of an interest rate cutting cycle. I'm calling this the Ross and Rachel rate cut.
We're on a break. It's on a break.
Right? Exactly. This rate cutting cycle started in September 2024. We had a 50 basis points cut in 2024, and we had another 25 in November, another 25 in December, and we've been on a break. And so my starting point for folks who are kind of watching today is that every time you see this, we're at the beginning of an interest rate cycle, ignore it, because we're not. We're halfway through. Right now, the market expectation is that there's going to be 4 more rate cuts, 2 more this year, 2 more next year, call that 100. The first phase was 100, the last phase is 100. The important part in this chart is what I want to kind of hit home on what we need to think of as investors. And this is that 74 and 80, you can see on the left-hand side, showing extreme examples of how this is really positive, right? Market really took off when the interest rates cut kicked in. That's because the recession caught everybody a little off guard. The market got hit. This is showing returns off the bottom. When you look at the ones where you have the green and it's up, it's actually where there wasn't a big market correction. You actually had either a shallow recession or no recession, and the market went on, and the market continued to go up, but it didn't have that big bang downwards, so the average number on the way back up is less. You get me on that? So when you look over on the far left, what we're saying is if we're not at the beginning of an interest rate cutting cycle, what we're showing here is on the far left-hand side is September 24 is looking at what the market has done since that rate cut. It's a 17.5% return. Meaning that on average, if your call here is that the market basically is saying there won't be a recession and they're all in. And so the best case scenario is that this is a very, very optimistic call on where we're going to go from here. That's where we're seeing some of the frothiness in this. And I think we have to a little bit is folks need to take a bit of a break here. And why this is important is that this isn't the beginning of a new cycle. The beginning of the new cycle was back in September. And so we're well into that new cycle now. And now we have to think about, okay, we're halfway through this interest rate cycle here. How are we going to be making decisions from here? And I think that because your starting point on this is very different. If you're trying to say, well, this is the beginning, no. Yeah. And so it's at well halfway through. So let's start making portfolio decisions based on we're a lot later in the game than this. The question is if you were looking at something to square or hang this on, was, is somewhere a period between 1994 and 1999. If you wanted to say, to find something, well, let's try to find some similarities too. We were getting interest rate cuts in 1994. We were getting those interest rate cuts because of a global emerging market bonds concern. Right? It was called the tequila sunrise, worrying about Mexico's bond market. And then, of course, into '98, we had what we called the Asian contagion. We had problems in the emerging market there, and that filtered through the rest of the economy. Of course, meanwhile, we had all that. We had the build out and the growth of the technology side. You take which way is this global economy going, cutting interest rates. You put a technology layer in there, and at that time it was the internet. And you start looking at some of the valuations here. The question people start to circle is, oh, wait a minute, right?
Is it the same? Is it different?
Yeah.
What are we talking about here?
And I think maybe that's one of the things that we should probably work through today too.
Okay, we got lots of time to work through stuff. I want to talk about, because we've been showing, we have central banks cutting, the market's not pricing in a recession. So what does it mean for the fixed income markets? What in this environment, what are we thinking about fixed income?
Well, I think maybe the starting point for the fixed income side is that we have memories and nightmares of the last few years. Let's face it, interest rates have backed up. You kind of look at where our starting point here is saying, well, if central banks are cutting interest rates, clearly the yields are going to be coming down, and I'm going to start seeing a big positive movement in my bond portfolios. Well, that's not what we've seen. We've seen short end bonds going down, but of course we've seen the longer end staying up. So for us, I think maybe a 2 point here is a lot of what I've said over the last few months and wrote about and how we've been allocating is saying, let's keep our duration short. Let's think about how we are getting the interest rate return, and let's not worry and think too much about the capital gain part of this. I think we have moved along the spectrum here a little bit, and I think first thing you want to do is you want to look at anything that is kind of junky in nature or in high yieldy in nature, and triple C kind of in nature, anything there. that I would look at that as an equity investment right now, right? I'd say the risk on it is closer to equity risk. And so if it's equity risk and that the spread between that and an investment grade bond and a bond is actually quite low, I think you'll want to really be very, very cautious in that part of the market. We think for investment grade, there's still an enormous amount of demand in the marketplace for investment grade bonds. The yields are pretty good. Keep your yields shorter duration into 1 or 2 years in that zone. That's what positioning as an organization we're in, and we think that makes a lot of sense. On the government side, we think that you can probably add a little duration. You can move out here a little bit, and you know that kind of that 5 to 10 year zone. I'm not saying sell the ranch and go out there, but just you know, we've moved out our exposure a little bit, and we think that there's some opportunity on that side. Still, at the end of the day, the summary of this is you know, you're still kind of neutral to underweight in your fixed income portfolios. Still primarily looking at it, thinking about what am I getting for an interest rate or my coupon return, but there may be a little bit of capital gain in this part of the market as well.